Hey Andrew, great to have you along. Thanks on behalf of OpenCorp. Thanks for joining us today. I know personally, I'm really looking forward to the chat. I've followed you for a long time, and I think there are a lot of parallels between what we do because OpenCorp are really big on transparency and education for our clients. I know that you provide that with your commentary, so looking forward to talking to you. Obviously, we're in interesting times right now. What's your take on how COVID-19 is affecting the property market at the moment?
Well, look, thanks, Michael, and obviously it's a pleasure to be here, and I think we do share that, information hotline in terms of trying to cut through what is a lot of negativity, particularly at the moment, to do with the consequences of the coronavirus. Now, the one thing in terms of property that we can perhaps really crystallise is that this incident isn't really a reflection of the dynamics of the property industry. I mean, the impact of the coronavirus really is broadly on the whole of the economy and all of its sectors. And I guess the other point is that we're actually have come into a period in property where we've rebounded and reinvigorated after, a pause period in early 2019. And I guess that's an analogy we could use, that we're back into a pause period now. But that pause period isn't a reflection of the underlying strength of our property markets, which means that once we can move through the medical issue, we're likely to take off where we left off when the coronavirus first became a significant issue, which it is. Now, to what degree we take off, of course, is still a question mark. Because there will be consequences, economic consequences, from the mitigation policies that have been introduced by the government. But the foundations going forward for the property industry, even over the long term, remain quite strong, and that's why we see through periods of pause modes that we've had that the property market takes off and builds. It is an issue that's affecting everybody. And for the property market, I guess the real question is to what degree during this coronavirus period will buyers and sellers still be engaged in buying and selling? And that'll, be revealed over the coming weeks. But certainly you would expect there to be fewer buyers and fewer sellers. But I do think that this pause mode will again reinforce not just the underlying strength of property, but the fact that we paused on a high and not on a low, and we therefore have the positivities of the market to build on as we recover.
Yeah, it's a really good point you make, I think, because we've been talking to our clients over the last couple of weeks about property's a long-term investment vehicle. This is a short-term scenario that will blow over, at some point in the near future. And normality will be restored. Recovery is always good, and they're always or usually fairly rapid. So, would it be fair to say that at the moment it's really a sentiment-based impact? The economic impact will flow through as there is a rising unemployment, which we're starting to hear about. But it's really just kind of the hysteria at the moment that's driving the general sentiment in the market.
Well, look, property is very sensitive to confidence.
Yeah.
And as I said before, that our lessons are quite recent in terms of the impact of confidence or lack of confidence on housing. And the reason is, of course, because housing is such a significant factor in our lives. And even particularly in Australia, because Australia has almost a unique connection to home ownership and small-scale home investment. And it's because of that, in a sense, that we are very sensitive to any sense that there might be, a negative element coming into property. So, headlines of doom and gloom, crash, always tend to create, almost in a way, a self-fulfilling outcome. Now, we saw that in 2018 and 19, when we did have a lot of negativity. Of course, it was generated by a restriction of finance for investors through APRA. But then that became almost a snowball effect when prices inevitably started to fall. And then we generated those doom and gloom hysterical headlines about the level of potential prices fall, which was never going to happen. But then we saw, once confidence started to re-establish itself gradually in early 2019, and that was generated by buyers perceiving this is a good time to buy, and gradually that trickle became a flood. And by the end of 2019, we were in boom markets in Melbourne and Sydney. And that has continued in 2020. So it is a confidence issue in reverse, but it was catch-up mode given the lower levels of confidence and activity early in 2019. We switch forward a year and we have the same environment, which is a potential lack of confidence because people, want to know the potential impacts, not just on their market, but on their lives, their jobs, of the mitigation against the coronavirus. But it's not a reflection of specific concern over the housing market in the first instance. It's just a general, we don't know what's going to happen here. And I think the thing, and I'm not a medical doctor, is that on the exposed evidence that the coronavirus has a finite period to when it's contained. And the government has taken strict measures to make sure that containment has come early in Australia, with cases still very low, that it doesn't spread. So once that's contained, then we move into the reduction of the mitigation quarantine policies, and then we get back to normal. And I think in a way what's something that at least we can look at as a positive in terms of the timing of this is that we've moved through the autumn selling season in a very strong market. We're coming up to the Easter break, the school holiday break, which was normally a semi-pause period in the market anyway. And then we have the last gasp, which is the May market. And then we move into the midwinter market, June, July. And July is typically, except for, of course, January, the slowest part of the year for property. So in a way, we've seen with the coronavirus, the winter market coming early, that, it's going to be a matter of perhaps a slow May and then a build back with the coronavirus behind us back into the usual springboard in the September market and the spring selling season. But I do think that this will be accelerated by government actions.
I like the point that you made around Australians' affinity to property, because I guess we've got the hindsight. We've been through financial crises and recessions and SARS and swine flu and all those tough lending restrictions. We've been through all those conditions, and one thing has remained true to me over all of these different downturns of some description, and that's that Australians have the affinity with property. Yeah. They love their house, right? And they kind of bunker down, and that's why it provides that stability in the asset class. Because you read a headline or you see a share price drop, you start to panic. Yeah. There's a lot of volatility. The share market's very liquid. Yes. But you can't just sell a house within an hour of deciding that you want to. And people's home is their castle. So hence why we see, a kind of benchmark or a floor around property, and why it doesn't have the same dramatic crashes that stock markets do.
Well, that's right, Michael. And look, I think that, why would you sell your house? I mean, you've got to live somewhere. And of course, there might be, I guess instances where you could live with someone else, but why would you sell your house? And again, I guess the fact of that illiquidity in housing versus the stock market is starkly revealed of what the response has been to the coronavirus. Is we've seen a dramatic crash, predictable crash in the stock market, a stock market which has really underperformed since its pre-GFC peak. We've seen, until the coronavirus hit us, that the All Ords in Australia had only increased by around 4% since its previous peak prior to the GFC in the end of 2007. And in that time, Melbourne and Sydney house prices have doubled. Yep. And even the US stock exchange had doubled. And the point is, we hadn't followed the US stock exchange upwards, but by gee, we followed it downwards. And that's the exposure to outside sentiment that stocks and shares have. And it's another factor why we've seen a growing interest in residential investment from smaller investors, not just because it's more secure, but because also in this low interest rate environment that we have, it actually provides a better yield or return on investment as an income source than you can get on similar blue chip assets such as cash. So this is going to be part of a movement, I believe, in more investment and interest in bricks and mortar investment from particularly smaller investors. And again, we have to look at the impact on superannuation of this fall in the share market. I mean, superannuation is very important for Australians. It's your retirement income. and we're seeing obviously a dramatic decline in superannuation balances. Again, you know,